Hello, everybody. It's Brian. All right, let's talk about our fun stuff here regarding gold spot XAU USD and the markets. So here we're going to use the Nasdaq. Okay, this sudden increase is because of what the Nvidia increase has been pretty steady. You can see here that Nasdaq has slipped today, and this is all due to the debt negotiations, and the vote goes tonight into Congress. If it doesn't pass, then you can expect blood in the streets, as they say. Anyway, so here is the news. This is from mining.com. Headline here. Oh, geez. Okay. I don't know why I do that. Let's see here. Oh, there we go. Okay. So, good place to start here. Spot gold gained 0.9% per ounce by 11:30 Eastern Standard, failing by as much as a half a point earlier. U.S. gold futures were up 0.8% as well. I do everything in percent. So the dollar, meanwhile, eased a 10-week high, making bullion cheaper for holders of other currencies. So I've talked about that with other currencies, namely a good example here is, let me just get over to TradingView without messing myself up. Okay, there we go. So I can put in a comparison of, let's say, so we have XAU USD. So let me just show you XAU Japanese yen is the best one. I've shown this multiple times. You can already see the difference there. It's 10%, 10.69% versus 6.85%. So that's what that article is referring to. Along with these positive elements, you could see some fund managers squaring up positions at the end of the month, taking profits on their short positions and buying back. Near-term gold prices are going to trade sideways to lower until we see a fresh catalyst. That's the Congress vote. If it passes, then obviously gold will go down, stocks will go up, namely because it's tonight, it'll probably start in Asia. Traders were assessing Friday's surprise U.S. economic data, bolstered for further monetary policy tightening to curb inflation. Prior to the data release, bullion has dropped to its lowest in 2 months. So let's take a look at that. That's kind of important to know. All right, so if you look at, let's do a daily comparison here. All right, so daily performance here. This is the frustrating part of it all. Even on a daily view, you can see that gold has correlated around stock for a good since October, and then it's starting to move against each other, and that's what's driving that is the world of the debt negotiation. So this should not be happening. This gold and stocks should not move together, okay? But it's doing what it's supposed to do traditionally. If stocks go up, gold should come down, and that's what we're seeing. And as you can see, that's going all the way back. You can see this here. It was like that during here, September 20th. And then look at gold. It just went flat. So that you should have seen gold drop way farther than what you're seeing here, where it just goes flatline. That's how distorted traditionally it is. So we're starting to see the typical traditional relationship, indirect relationship between gold and stocks right now. So if I go to that started May. So this is the traditional in the last month right here. So gold, let me get rid of this Japanese yen here thing. So you can see here, this is the typical breakdown that we should start seeing. But gold is not dropping as it should naturally. Why? Because gold is suppressed. Trading desks maintain those positions. So, but the key, and I would be concerned if you were a gold trader, is let's say just on the last year alone, Gold and stock should not move together. Gold is supposed to be an asset you hedge, but they should not move together. You're seeing that now as we have a calamity on our hands. Okay, so yeah, I mean that's how it is. Should be in the old school days, right? Okay, continuing with this article for those that just joined, we're here at mining.com. Gold price rebounds as U.S. debt deal weighs down dollar and yields. So earlier worries on the U.S. debt deal, that's what's driving this, has supported prices. Repricing of the Fed rate hike was keeping gold pressured. Saxo Bank head of commodity, Ollie Hansen, noted. The Fed more likely to see rates hike next month, and I'm listening to Bloomberg. The probability of that is yes, they will raise rates, even though inflation's not kicking in. The reason why they want to raise rates, from what I'm seeing, because the unemployment's not rising as they want. So they're going to kill off job creation by raising rates so that they can break more things and hope that it goes down. So unfortunately, that's the way the Fed works. And you can, if you dig deep enough, you'll know what I'm saying. Traders now see the Fed as more likely heights, okay, with the debt deal easing some of the economic risks that could have the central bank on the sidelines. And that's true. And I don't know if you've heard in the debt deal, they're saying they want to do nothing until after the next election for the presidency next year. So they won't do anything until afterwards. I think that there will be some big calamity coming. I don't know what. But if they're going to raise interest rates, there's going to be something breaking, and then they'll have to step in and go through all of this as well. But what the political elite don't get, depending upon what political side you are on, they're not factoring in that there is interest that has to be serviced while you carry this $131, $32 trillion, and that may push gold up. To deal with its first test, Congress, both Joe Biden and congressional Republican McCarthy expecting enough votes to pass it into law. Okay, so again, nothing's guaranteed there. Anyways, I just want to show you what's going on. There is another article I think I can show you. Let me just see if I can find it here. This one. So if you go to this bogleheads.org, this is an interesting forum post I found. Gold in a portfolio. April 20th. So there's some really interesting discussions here. Downside volatility for wide spectrum equity to bond gold allocation, 75 to 2022. So you can see here, if you go through this, you can see what's going on. Equity and bonds and gold. So you have some really nice charts here and some really interesting discussion. I'm not going to get into that, but a lot of that's just talk, right? Right now, if you look at, we're going back to, let's go back 5 years. As I said before, starting in March 20th, when we had the global sickness kick in, markets still went up, right? And that is NASDAQ, okay? So the market still performed pretty good since the global sickness kicked in. Dropped back, okay, last year, as you know. But look what happened with gold. Gold just stayed flat. And traditionally, this should decline. But I think that this stayed elevated is because people are piling into gold and keeping that price elevated. And you're starting to see, as I said before, that relationship break apart now as calamities come in. So as long as we have calamities in the U.S. markets, if it's government-driven, debt-driven, war, whatever, you can expect either, let's just go to a 5-day view here. You can expect gold should continue to move up, just depending upon what goes on out there. But nobody can really predict that. But if they do raise interest rates next month with the Fed, you can expect things to break again, be it banks, be it whatever it is, and then gold will start to spike. That's my view. So we'll leave it at that. Any questions? I don't see any. I'll be back. Just so you know, I'm experimenting with this streaming on TradingView. What topics do best? People seem to like the gold. I know gold and Bitcoin are the top two things to talk about on TradingView. So I'm going to do some crypto altcoins separate streaming sessions. So we'll see how that goes, and I'll continue just to focus on what drives the engagement. Other than that, no questions or comments. So I will drop off, and you'll see me back if I'm back. I'll be back soon. Don't worry. All right. Have a good day. Bye.